This is Chris Carlson, and welcome to the Boulder Banking Podcast. My guest is Richard Hamm, president of Advantage Consulting and Training. Richard has been training bankers for over 29 years with a focus on real estate lending. He teaches all over the country and serves on the faculty of GSBC. This was a fascinating conversation about all things real estate. Richard gives some great advice about what bankers should be thinking and doing in these unique times. Richard, thanks for joining us today.
All right, Chris, thank you for having me.
Richard, there's a lot I want to talk about today in terms of commercial real estate and what's going on there. But before we get started, can you give us a brief background of Richard Hamm?
Yeah, the short story is lending, training, lending. I was a lender for 6 or 7 years and then did the training full-time, the commercial loan, commercial lending entry-level training program for a large bank holding company for 4 years, and then went back into lending. But I continued to be connected to training, even though I was a full-time banker, through the Risk Management Association, RMA, some of our banking schools and conferences and things. And so while I was a lender again and moved into senior positions, continued to train, and then about 15 years ago, saw the light and jumped out and just did the training and consulting full-time.
Well, as we look at 2022, how many training sessions will you conduct either in person or virtually in 2022?
People ask me how many days a week are you traveling or all that. And I really don't obsessively analyze myself, but I think between the banking schools and the other things that I do now, it's easily 20 to 30 programs plus a larger roster than I probably want to count of webinars.
It kind of begs another question, Richard. When we were in 2020, how did you conduct this training? Were there a lot of virtual meetings, or did people just slow down and say, we're going to take a pause?
Well, the in-person things just stopped because nobody was really ready. If they weren't already doing something virtual, they weren't prepared to. And fortunately for me, with two groups that have a national profile with webinars in the credit and lending space, I was already active there. So it wasn't like suddenly I'm sitting around with nothing to do. I still had the webinars, which had been growing as a part of what I was doing. I was just lucky. I didn't know anything better than anybody else. I was just lucky and fortunate to already have, webinars in place. And with one of those groups, we greatly expanded the offering. So I stayed busy, but it took probably 3 months for state banking associations and other groups to sort of flip the switch and get accustomed to virtual and get it set up for things more than just a webinar. And so I was doing most of my, I'd say about half of my in-person programs are one-day training sessions. And it was difficult to figure out what format. Can you have somebody sit and do a virtual thing all day, or do you break it up into chunks? And if you break it up into chunks, do you spread it out over multiple days? It took everybody a while to figure that out.
I would agree with you there. And I'm guessing the in-person training has come back with a vengeance, has it not?
Well, it has. And, I think everybody, they didn't dislike Zoom. It's just there was a lot of Zoom fatigue, just not the individual sessions themselves, but having done it so much over 2 years. So I think everybody's ready to get back to in person. We're not totally done with COVID. And so, I think it'll be another year or so before we really get back to normal.
Well, Richard, let's talk about commercial real estate. You are doing a lot of these training sessions. What are your students asking you about in terms of commercial real estate?
Well, I think for the newer bankers, it's this fear. We haven't seen this before. Maybe they have remembrances of the big downturn in 09 and 10 when maybe their parents saw house values go down, but it's different being on the outside versus now being with a bank. And the other thing for more experienced bankers is this big question, what are we missing? Because we're not seeing past dues or any of the classic warning signals yet. Prices are not going down, even though the upward momentum on commercial real estate has if you look at national companies that track this, their broad indexes are just totally stalled out right now. One of the major ones, 0.2% growth for all of 2022 year to date, after 24% last year. So we're not seeing any warning signs. I'm hearing glimmers of perhaps cap rates going up, but there's always a lag there too. So I just see a great big pause right now as investors figure things out. We're just in a holding pattern.
Well, Richard, you mentioned '08 and '09, and I'm guessing that in your classes, you have bankers that were not even in banking during that time, and they haven't, to your point, experienced anything like that. And many times they don't know what they should be doing next. Is that a fair statement?
I think that's a fair statement. And that's why when I'm doing more general topics and even just a basics on doing cash flow, I frequently throw up a chart that shows the roughly 39 to 30, depending on which index you look at, the 39 to 37% drop. And these are broad indexes. They include manufactured home parks, nursing homes, in addition to the normal apartments and office. And when you see 37, 39% go down, I see light bulbs go off in the room. It's just, yeah, that really can happen. But in a way, it's like telling them, I came into banking not too many years after a 21% prime rate, and that seems like dinosaurs and Model T Fords, but it's real. And, we're in an interesting rising rate environment now.
Well, Richard, based upon what's going on in our economy today, is real estate still a smart asset for people to own?
I think this was an interesting item that came out in the program I did earlier today. Just this idea of, it seems like to some of the lenders I interface with, that some of the more experienced investors, maybe they aren't the smarter necessarily, but more experienced, are taking the opportunity to sell properties right now. But is it really true that the younger investors are making a bad decision because these properties typically have a good tenant base? They've got a good track record. They've been well kept up. Is it still a good chance for someone that's new to real estate to get in there? So I think comparatively, given that equities and bonds, stocks and bonds are more or less down 10% year to date, even though real estate's flattened out, I think real estate with some key solid attributes, I still think it's a smart asset to own. What's interesting is there is a great amount of construction right now, particularly in the warehouse and apartment space, and residential is crazy. So, it's hard to argue right now that real estate's not a smart place for one of your borrowers to be.
Well, I'd like to talk about some specific areas of real estate if we could. Let's start with hotel properties. What is your view of that segment of the marketplace?
I think in today's environment, that's maybe one of the best ones you could have asked me about first, because I've been telling programs, and I'm not the world's expert, but in my view, we've always subdivided within these broad categories, but now it's more important than ever. And hotels a great example. Your large 8, 9, 10-story convention, trade event type of properties, I think aren't there yet, because, we really haven't come back to all these big business meetings and conventions quite yet, versus the extended stay concept that's done so well during the pandemic, and just roadside, hey, I'm just stopping for the night, my family's on vacation kind of property. Those did well during the pandemic. So I think now more than ever, you've got to subdivide property types. We can't just paint with a broad brush and say hotels are bad, although it seems like the investment community is really keen on hotels simply because of the theme they perceive that there's going to be a big recovery in travel this summer or later this year. So I think they are looking more broadly at just about any hotel property. I think as bankers, we should be a little more narrow and subdivide more.
Great advice. Let's talk about another area nursing homes?
Wow. This one, I showed a slide in a program today where employment in that industry is down almost 50%, just numbers of employees. And a lot of it is, employees not wanting to comply with a vaccine mandate, or just nursing home jobs aren't easy. So it's interesting to me that they are really desperate to fill their jobs in a category where demographically they should have, and a lot of them do have, waiting lists. So what I can't figure out is, can they raise their prices enough to cover their costs given the demand factor? And then a lot of that is limited because of government support, Medicare and Medicaid paying for a lot of those beds. Nursing homes, I think, are going to be particularly challenging. And to me, what their challenge is more on the employment and how they fill positions. I think people have heard episodes of traveling nurses and traveling positions at hospitals. It's happening in nursing homes too. There's a lot of transient or temporary workers that aren't permanent employees. And that's scary to me, that they have a big time employment problem.
Well, what's interesting is a few years ago, nursing homes and assisted living facilities were the go-to place for investments because of the demographics. And so when you take a look out and look into your crystal ball, we have this increasing aged population with employment shortages. I mean, is there a big time collision coming up?
I don't know how you correct it. I think what it's pushing is more attention to care in the home and letting people age in place, not at a facility anymore. I think it's going to force the issue of more home-based care. But again, I haven't really seen many statistics on that industry too. And that's a very tough industry for those employers to find employees as well.
Last specific area I want to ask you about, and I realize this is a broad area, so you might need to break it down: office space.
Yeah, office, the classic word that kind of came about in the 08-09, what we call the Great Recession, these headwinds. And more than any property, office and retail have such headwinds. And again, you're right, it's the subcategory that matters. I think downtown office towers are very questionable. There is data out there that there are significant amounts of leases either coming up for renewal or reset the rental rate, and that's got to be a problem. And one article called it a wall, WALL, of leases coming up for renewal in the next year or two. And then you switch over to medical and dental, and with, again, the demographics behind that, I don't know that I can go. I like to tell programs this. I don't know that I can go visit my dentist virtually. Oh, Richard, get your drill. Okay, open your mouth. That's not happening. So there's certain kinds of office, a life insurance agent's office or a title company. I don't know that those are going away as much as I think the big question in office is these large downtown towers. And I think those are situations where the workforce can work more remotely, more from a hybrid situation than you can in more rural situations. And so I really see that as the problem area of office. So if you can't break that out, office statistics may be, if they're broad, they may be a little bit misleading.
Well, you talk about those downtown towers. I read a lot about how developers are trying to convert office space to condos or apartments, but yet there's a lot of difficulty. What are you seeing? What are you hearing regarding that conversion?
Well, I think there's two cross currents happening there that I haven't figured out, and I probably can't. And on top of that, I'm not seeing any experts that really have a great answer either. These two cross currents are, number one, we have a lack of housing in this country, particularly single family. So it's keeping apartments very strong. We have somewhere in the order of 800,000 apartment units under construction right now in this country. And it's been almost a straight line upward since the Great Recession. And for all that 10 or 12 years of upward growth in the numbers of apartments being constructed, there's references, there's got to be a bubble. Well, we've been talking about a bubble for 12 years, so I don't know how you can keep calling it a bubble. So there is demand for the condos and the apartments downtown. There's a demand current, but then there's the cross current of some people. The second largest age group behind the baby boomers that are 65 plus is your 35 to 45 age group that's growing like 6 million people. And it's not new people, it's people aging up. It's just the next biggest cohort in this country. And they have school age children. So that's the cross current. They're the ones going out and need the single family home, the yard, all the classic things. And they're exiting the downtown. So that's the two things. I don't know how you rectify that. And if truly the downtown office towers don't get repopulated heavily, does it make sense to live downtown and then commute to a job out in a suburb? Or what do you do about your kids? Let's take Atlanta, for example. There's some nice communities in the Atlanta area, 50 miles out, that are on lakes and those areas have done so well because people can work remotely and work out there and not have to put up with the traffic and all the other things that you put up with in a large metro area like Atlanta. So I think there's cross currents on it. I think there's merit to doing the conversions because one of the smaller cross currents, believe it or not, the 65 plus group is attracted to downtown because they don't want to drive their car and they go down the elevator and there's a restaurant next door. So believe it or not, you've got some of the old aging people that would like to be back in a more dense scenario. So we've got a lot of things at play that I wish I knew how they would work out, but I just try to watch and listen, and you've hit on an interesting trend there.
Well, Richard, let me talk a little bit about what bankers should be thinking and doing. First question I have for you in that area is, how is the loan to deposit ratio affecting how banks are deploying their capital?
Well, it's forced a number of banks. Well, let's back up. The loan to deposit ratio is at all-time lows if you go back to statistics, even back to the 1970s. So for an industry coming into the pandemic, cruising along at probably a 78% type of loan to deposit ratio, meaning the numbers of loans, your assets are short of, you haven't been able to deploy all those deposits, or you would be at 100% loan to deposit ratio. So it's forced, we're down to about 65% now, which doesn't sound like a whole lot, 78 to 65, but that's a lot of dollars. And this is everybody. This is JP Morgan Chase. This is First National Bank of small town. And what it's done is forced a lot of banks to buy investment securities, usually bonds. And that's not been a pleasant place lately, because if you haven't sold it yet, you've got an unrealized loss sitting there that's actually affecting some of your capital numbers. The other thing is some banks that were lower than others, almost all banks, I would say 95% of the banks I interact with in programs are in a lower loan to deposit ratio than they've been in the last 15 to 20 years. So they are very motivated to deploy that money into loans. And I think yesterday Fed funds paid 0.81%. For a while, it was 0.1. And if you can't loan out all that money, it sits idle in Fed funds and doesn't earn you just a little bit above zero. So even in an environment of 0.81% for Fed funds, a 3% loan's really attractive to a bank. So that's the crazy thing that's been going on top of an already competitive situation, where even some really rock bottom loan rates are very attractive compared to the alternatives that banks have for all this deposit money. But here's the thing. Banks' cost of funds, because of this loan to deposit dynamic, most banks are not motivated to price their CDs or their money market accounts higher to get more deposits. They don't need more deposits. So even though the Fed's raising rates, banks aren't really, I don't see many banks wanting to compete with each other to get deposit money because they don't need it. So it's going to keep cost of funds low for the next year, maybe 2 years, before banks really have to attract deposits again. And when those cost of funds rates are low, I think it gives the bank the ability to continue to price fairly cheaply for loan rates. And so that's something I think will affect real estate in the next couple of years too, is can real estate borrowers continue to borrow as cheaply? And the bank has to also not just say, well, what's my cost of funds today? If I offer a 3 or 5 year type of fixed rate, where's my cost of funds going to be in 3, 4, 5 years? And that's what we just really don't know, because banks, I'm not familiar with a Fed tightening program where banks have been I've used the word and I've seen it in print too. Banks are just drowning in deposits right now.
My next question is a two-parter. Is the current environment lulling banks to sleep, and should they be concerned?
I like your choice of words. I do think they're being lulled to sleep because there's no past dues. You really don't have customers experiencing any problems right now. I do think you should be concerned, and I think a bank should have a strategy to address those concerns. And I think it starts with paying attention to property types that are not doing well, certain types of hotels, a good bit of your retail, certain office properties, nursing homes, other senior living facilities probably should get. I had an experienced banker early in my career say, Richard, when things get tough, we have to go to the second level. And one of the examples of that person shared with me was things we do annually, maybe we should do them every 6 months. Things we would normally do every 6 months, maybe we dig in every quarter. So in our industry, we have this standard of more or less doing an annual review on most of your commercial real estate. I think for those categories I mentioned, loans that haven't paid down much, they're still early in the amortization, so you're still pretty close to the loan to value that you had underwritten. Loans that they have an acceptable debt service coverage, but it's not way above your standard, or you don't have a particularly strong guarantor or sponsor that has good reserves and liquidity or other strengths. I think if you don't have any of those characteristics, I don't care what property type it is, I think you maybe should look at it every 6 months for now. The same way when someone starts to have medical issues, usually your physician wants to see you more frequently versus the sort of standard annual visit with your general doctor. And so I think that's how banks should use this concern and uncertainty. I think the bigger word is maybe not concern. I just think there's a lot of uncertainty right now. So for now, I think you can easily map out. It's not your entire portfolio, because you don't have time to relook at all your credits 2 times a year versus the traditional one. But you can sort of screen or strategically look at your portfolio vertically in terms of the type of properties, no matter how good the metrics are. I think I'd be looking at nursing homes, certain kinds of office, retail, that kind of thing. And then where you don't have really strong, I guess you call it fortress credits with a low LTV, a really high debt coverage, a really strong guarantor, I think you look at it every 6 months.
Well, speaking of looking at your portfolio, can you share with us the Walmart story that you told me?
It's one of my favorites. It involves a smaller community outside of where I live, about 50 miles away. And it's a lesson in paying attention to the leases that are in place. And I didn't even get into that yet, but whenever we have weakness in real estate, a lot of things that are built into these very complicated business lease situations, and it's more a commercial property renting to businesses. So it's going to be office and retail and industrial. Apartment, and hotels, you really don't even sign much of a lease agreement, but apartments and self-storage, it's more simplified. So it really doesn't apply to those. But when you've got these business leases, they can be very complicated. So as quickly as I can tell it, I'm doing training for the bank in this community, and I gave them the option of doing one of their cases instead of one of mine. If there's anything hot off the press, ready to go that they're working on, and let's go through this. So it involved a 2-store, very small space, an out parcel adjacent to the local Walmart. And in the last 20 years, and they confirmed this for me, that was the 3rd Walmart location in this community. So we ran through the numbers from the tax return schedules. We were able, the leases were attached in the package that the senior lender put together, and the leases confirmed the amount per square foot and all the data, and everything was great. So probably makes sense from a debt coverage, loan to value type of situation. It should be a good loan for this bank. Well, next on my agenda was to discuss some of these subtle and sneaky sort of, they're buried in the fine print lease things that often get overlooked. So half the room took one lease, half the room took the other, and they started reading, and it didn't take any time. It must have been page 3 or 4. Hands go up or people start talking, and there was a very interesting clause that was in both of the leases. And these were 2 smaller retailers. You would know their names. They're national companies that have done fine in the retail space. They're not big, but obviously those locations were very dependent on all that traffic being driven by the Walmart, the traffic draw. This lease clause said if Walmart closes or moves, the lease is over. I mean, maybe 10 words at the most. It was blunt. If Walmart closes or moves, the lease is over. Now, in broader terminology, that's called a co-tenancy clause. It happens in retail. It doesn't always happen in retail leases, but a smaller tenant like that names the Gap or an Apple store or P.F. Chang's or something that, I'm a small retailer. I'm a mom and pop or whatever you call them. I'm dependent on the other bigger stores bringing people here, and then they come to me. And this bank was proposing a 20-year amortization. The Walmart's already moved 3 times in the last 20 years. How do you underwrite this? Walmart had already been in this location at least 6 or 7 years. So how do you underwrite something like that? And it's not like I'm the world's smartest banker or anything. Again, we were fortunate that I got a chance to use that transaction in class, and I asked them to read the lease. I'm not sure that any of their bankers would have really studied that lease beyond extracting the numbers to do a debt coverage. It was a great lesson that, sometimes you need to get into the details, and it's little clauses like that. It's going to take an economic disruption for Walmart to close or move that store, more than likely. But how do you underwrite that? And it's just, leases have interesting clauses and covenants in there that can be anything. That's the most, usually if Walmart closes and moves, my rental rate gets cut or something. That's what you typically see, not just my lease is over. I mean, what's the landlord going to do when these 2 tenants come in and say, hey, Walmart's gone, see ya? I think the landlord's going to be desperate and, can I cut your rent? Can I give you 6 months free rent? I mean, it's got interesting consequences to it.
So in that particular class, did you guys come to any conclusion?
Yes. My first reaction for the senior lender was, if you have an attorney that you regularly use, I would have an attorney read this lease, because we're not attorneys, and there may be something on page 8 that counteracts whatever was on page 4. And maybe it's not as serious of a deal. I would probably get legal help just to understand. There could be other clauses in the lease that have to trigger before this one triggers. There's things you do. The other thing we discussed, it really puts a lot of pressure back on the strength of the guarantor or the owner. And what are their other properties doing? Is this a normal thing that they offer in their leases? The other thing that came out, one of the participants had a really good comment was, I'm curious how much experience this landlord really has if they allowed that to be negotiated in. I mean, couldn't they do a better job of negotiating on their behalf? Because it sounds like they had to really agree to something that's I don't know that I'd ever seen something that blunt before.
Interesting story. Thank you for sharing that. Well, Richard, I want to get you out of here today on this question. What are the top 3 things bankers should be on the lookout for, or what should they be avoiding?
If you'll let me expand it to 4 things, because I really think 4 things drive the viability of real estate. And the first one sounds redundant because it's viability of the market. We've got to really watch the economy, because some of these real estate properties are dependent on a healthy economy that creates jobs, that keeps population in your area. And a lot of these things, this whole viability of the market category has too many things that are not in the borrower's control or the banker's control. If you're not an economist, you need to really pay attention to the economy over the next year. It's going to affect your real estate properties. Number 2 is sustainability of income. So tenant quality, lease terms, flexibility of expense reimbursements and things that landlord might be getting. This kind of gets to that second level I mentioned earlier, that gets you past the loan to value and debt coverage and your basic underwriting, and you're having to get a little more specific about things. The third item is stability of value. You've got properties that are well located, well positioned. They've got good visibility, experienced property management. You've got a lot of that going on that can help protect you when viability of the market perhaps is weak. And then one of the things that's unique about commercial real estate versus other kinds of collateral, a discussion came up today, how are you valuing cars if you do a small consumer car loan? Is it NADA, Kelley Blue Book, all of that? And it's interesting how much money the former car owner made. If you have to repossess a car, how much money they were earning has nothing to do with the repossessed value of a car. Well, unfortunately, and so that the collateral is somewhat independent, totally independent of the income of its former owner. Real estate doesn't work that way. If the apartments weren't rented very well and they weren't making money, the value goes down. There's not a Kelley Blue Book that says, a 100-unit apartment building in Springfield, Illinois is automatically worth this. They don't work that way. It depends on what the income was. And so when you have codependence of your primary and secondary source of repayment, it forces you to go to the third level, which in most situations, that's your guarantor or sponsor. So when things get difficult, the value's not going to be there. If you have cash flow problems and it's on the past due list, your value now is questionable. It's that direct relationship between the income and the value of the property via the cap rate that connects the two. So now it shines a brighter light. Most of our community bankers are getting guarantees. I would be relooking. I said, look at the property itself every 6 months. I probably dust off my information on that guarantor or owner and relook at that perhaps more frequently, because that's where you're going to end up.
That's some great advice. Well, Richard, you have shared some great ideas today. If somebody has a question or maybe wants to go a little bit deeper on something that you mentioned, what's the best way for them to get in touch with you?
The best way is just good old-fashioned email, and I have an ancient email address, and I'll be happy to lay it out for everybody. It's advantagecons, just the word advantage, with CONS tacked on to the end, no punctuation, and it's short for Advantage Consulting, at bellsouth.net. the easiest way to reach me.
I'll make sure I put that in the show notes, Richard. Well, Richard, look, I know you're traveling. You were kind enough to rush from your class today to get to a point where you could do our call. So I really want to thank you for taking time out of your busy schedule to visit with us today.
Well, you're welcome and glad to visit with you. And you had some great questions for me. Thanks.
Well, thanks for your time today, Richard.
All right. Thank you.